Good afternoon. Welcome to the TheoTrade afternoon video. I am Blake Young. Today is October 9th, 2025, and we're going to talk about consumer discretionary and leisure as it relates to the overall global economy and U.S. economy. So I'm going just to look at the last couple of weeks. We could go back further, and you're going to see it's even more dramatic if we go back further, but we're just dealing with the last couple of weeks with news and information. And what you'll see is every report was at average or expected forecasted rate or missed, except for pending home sales. Now, I believe the pending home sales here in the U.S. last week on Monday is still the idea, the concept that people said, hey, we cut rates, so we're going to agree to buy a home. We're going to have a pending home sale. We might put things under contract, but I don't believe that it's going to jump 4%. I think we're going to see a unwinding of many of those pending home sales, and we'll have to wait and see if it actually gets to a closed home sale. So let's say existing and new home sales. So that's the one bright spot. Everything else overall has shown slowdowns. Spanish CPI, not the biggest economy, but one of the top 4 economies in Europe. And they're declining. Inflation is sliding in Spain. Now, that doesn't mean that that's beneficial for the consumer. It means that we're probably seeing slowdown in demand. We can see manufacturing missed. We can see down here consumer confidence is sliding. We can drop down further and see ADP non-farm payroll that was very bad, negative now the last 2 months, and getting worse. And that means we missed by 80,000 jobs. Now, if we knew what the non-farm payroll was from the government, we might be able to confirm that we're seeing job losses. But because the U.S. government is closed and we're furloughing multiple employees, thousands of employees, tens of thousands of employees, we don't know because they didn't report it. And so we have that delayed, revision, or canceled. So we're not even being told the full story. ISM manufacturing and services missed, and it was just not a great week last week as far as global economic growth or contraction. We're definitely seeing slowdown and decline. If we go to this week, there's not a lot that we can look at other than we have some holidays, we have a bunch of speeches, but the fact that New Zealand's cutting rates, they went from 3%, they're expected to go 2.75, and they dropped all the way to 2.5%, is a further indication that we're scrambling. We're looking at this as saying we need to support the economy, we need to encourage spending, we need to provide more liquidity, and New Zealand acting aggressively by cutting 2 cuts instead of 1 is probably another sign of economic slowdown. Now we have our meeting minutes that came out, and we've used that to get some ideas of what the economy is doing. And down here, Friday, we'll have consumer sentiment and inflation expectations. These are both expected to be worse than previous. Now, whether they miss that, we'll see. But overall, it's not real positive economically. And so if I look at the sectors, which sectors do I think will be hit first, hardest, fastest, most dramatically? If the global economy is slowing down, well, it's not necessarily information technology. We obviously have NVIDIA and Oracle and their group of sharing money going around in circles there with those big Mag 7 stocks, really Mag 8, but Mag 7 stocks, we're just going to see that money flow through there. And until we really truly get the bubble burst, it's just going to rotate around with those great big companies. So we're watching for that to change, but for now it's not going to be information technology or communications. Consumer staples, I don't think that's the place to go against either, but maybe industrials and consumer discretionary. And we look at consumer discretionary and we know the consumer is already strapped. And so if we go look at the consumer discretionary choices, we have broadline retail like Amazon, automobiles, which I think is a good opportunity as I've already talked about during the main room. We can do specialty retail, all doing very poorly today. But this is the area I want to look at. Hotels, restaurants, and leisure. And something that's not listed here, that it would be still part of this in my view, and that is travel. And that means the airlines. So I want to look to short or go bearish airlines and leisure. So Booking.com, Royal Caribbean, Airbnb, Marriott, Carnival Cruise Line, Norwegian Cruise Lines, and the casinos, I expect to see those slow down. Let's take a closer look at these companies and look at their charts. And just a quick aside, I said last Thursday that you want to go short rocket. Look at this. Gap down, close down. 1, 2, 3, 4, 5 days in a row. And this is what our break was last week. But let's go ahead and push that aside. Just remember, we did talk about that. That's the kind of structure we set up on these Thursday videos. But let's go take a look at some of the individual stocks inside leisure. Starting out with the cruise lines, we'll go with Royal Caribbean. As you can see, Royal Caribbean has pulled back from its high, 366, all the way down to 306. So we've seen nearly a 20% decline in Royal Caribbean from the top. If we break through this support level, I'm looking for an additional $60 move, which means if we break through 300, we're looking at 240. And if we go to 240, that would make sense, because if we are unsure, if people are losing jobs, if we're getting tighter in our budgets because inflation is still high and salaries are not increasing at the same rate, we probably aren't going to be booking expensive trips. Royal Caribbean is, again, selling off 20% from the high, and we could see an additional 20% and drop all the way down to 240. If we take a look at Carnival, Carnival is at a similar support level. It's also gone from $32, a little more accessible, down to $28, and not quite the 20%, but getting close. And a break through 28, we should see another $4 move, and I'd be looking for 24, probably about $23.50 in Carnival Cruise Lines, or Carnival Corporation. If we look at Norwegian, Norwegian is also a cheaper stock, a little more accessible, and today to me seems like the trade. It is the one that is breaking free. If it's closing down, it'll be the lowest close that Norwegian has had going all the way back to July. And so this could be the breakdown, the continuation. I'm looking for this to break down and continue this same distance, 27 down to 23, about a $4 move, and we'd be looking at a target down to the 1950 area. So all of these are potential opportunities to go short, bearish, trade long puts, long put verticals, even long put diagonal. Now, Booking had a very positive day today, a big bounce off of the lows. And it's an expensive stock, so it's not one that I'm going to actively trade, but just to see it's the same confirmation. We've already broke through support. We'd look for it to go from 58.05 down to, say, 54. And so we're talking about $400, so we'd expect it to go down to 5,000. Almost got there. But this bounce through here, anywhere below this area at 53.10, could be the opportunity to short or take a long put scenario off of this. And we'd expect it to duplicate that entire range down here. Now, again, Booking is an expensive stock. I'm not necessarily chasing this one down, but it's more of confirmation of what we're seeing in the cruise lines and what we're going to see in the hotels. We'll start with Airbnb, then we'll do Marriott, and we'll do Hyatt. But as you can see, Airbnb is already in a downtrend. It has created a descending triangle. A break below 119 should repeat that move of about $10, and I'd be looking for a move down to 109. And that's set up for a pretty dramatic drop. If we look at Marriott and Hyatt, they're still coiling up. I think that actually is going to give us a better opportunity to sell premium up here, sell calls up here at 275. If we see the slowdown, which I do think we have, from all these other indicators, we should be able to sell call premium up above 275 and Marriott. Hyatt is similar, that we should be able to sell premium above 150, and we don't even have to have it go lower, but I don't think we're going to have a lot of upside potential in the hotels. Now let's take the last look at the casinos and airlines. And I know I'm going through a lot of symbols here because I think this entire sector is an opportunity to be fading. Las Vegas Sands is trying to roll over, created lower highs, lower lows. A break below 50.50 should bring you down about $6 to $8. And so we could be looking at this dropping all the way down to 42, which would bring you into the consolidation all the way down here on Las Vegas Sands. And if we look at this from the, let's use Win, similarly at support, waiting for that to break down, MGM, and you can see it's already broke support. Should be repeating this move from 40 down to 34. I'm looking for a $6 move, which will bring us down to 28. That means we're going all the way back to this support level and consolidation back into April. All of that's still supporting the idea that consumer discretionary spending is probably not going to spend money on leisure. And so if we look at the airlines, let's take a look at Jets, Jets. Gap up, close down. So it tried to move today, But this support level is the same game, same idea, same concept. Yes, we gapped up, we erased any gap up and it dropped back down to the support level. If we look at that, let's use global jets. We could look at that and dig into stuff like Delta, and same gap up, close down. So if we get through this low at 56, I expect another move of about $6 to $7, which will mean that we're going back to 50. If we look at my favorite today is Southwest. Southwest was the largest gap up, close down reversal in the airlines. And Southwest has a lot of things going for it, but it's also got a lot of things going against it. And the thing that I'm going to look at for Southwest is that they have a lot of changes they're exacting by January. And that includes assigned seating. And it kind of messes with their brand. So I don't expect a lot of positive with Southwest. Yes, I'm glad they're going to assign seating if they keep the prices the same. But it kind of messes with their brand of being the cheaper one that has the cattle call, which even though you don't like it maybe, it's still part of their brand. So it's kind of disrupting their brand. And when I looked at the financials under Southwest and dug into the financials here, they have a pretty rough quick ratio and current ratio. Now, obviously, we don't expect them to sell the inventory like their airplanes, but their current ratio is 0.55. They do not have a lot of cash. Their free cash flow went negative. It's now negative 47 cents per share. So we've seen a shift and a turnover in Southwest where they're not cash flowing, where their current ratio, meaning how's their short-term assets versus their short-term liability, is 0.55. So they've got to sell more tickets, they've got to sell more seats, they've got to be able to do more travel, and they've got to probably raise the prices to be able to do so, but they may lose market share in this move. Revenue has been declining from the 5-year to the 3-year to the current, and so the current year is 1.63, so $1.63 per share, where the 5-year average was 10.5. So they're almost 1/10. This year's 1/10 what the 5-year average is as far as revenue goes. That's a problem. And their dividends they've been cutting as well. So I think this is probably my favorite one, both in the chart and in the opportunity that is here. The premium on this, the implied volatility, is at 49%. So as much as I want to take a bearish trade, just flat out take a bearish trade and sell the stock, I may sell calls up here because the implied volatility is high. 49%, 50% implied volatility percentile. That means it's just about half as high as it's going to get, and I want to be a premium seller. So if I can sell calls at 34 and then possibly buy a put down at 29, so if I do get that directional move, I'll be looking for the short call vertical to pay for the put, and then at that point I'll have a directional put that should repeat from 34 to 29. That's $5 lower, and we're going back to the annual lows. From our current price, that creates a very large, about 20% drop from the current price. And I think that's probably my favorite trade on these leisure stocks for the day. So I don't see a lot of recovery in this. I don't see economic support to turn this around. It does look like, the pun intended, the boats have sailed as far as the reversal and bullishness here. So we will continue to watch for this to sail south and for the airlines to struggle getting off the ground again. So that's going to do it for me today. Thank you for watching. Join me again next week. We'll see you in the morning for the 10% Club, and have a fantastic night.